Welcome back, everyone, for another deep dive. This time we're wading into the waters of private equity, a world not exactly known for its transparency. You asked us to take a closer look at the Carlyle Group and how they actually make their money and, of course, the risks that come with the territory.
Always a good idea to understand the risks.
And you didn't just want us to skim the surface. You sent over their 10Ks, their own financial reports from the past few years. So listeners, buckle up.
Yeah, those 10Ks, they're like a company's financial diary. Not always the most exciting read, but wow, they can be revealing if you know where to look.
Absolutely. And a few things jumped out at me right away. Phrases like carried interest, give back obligations. Those sound fun, right? And of course, management fees. I have a feeling our listeners in finance are familiar with these, but maybe not everyone is. Could you break those down for us in plain English?
Sure, happy to. So at the core of it all is that firms like Carlyle, they're essentially financial middlemen. They're managing money for, well, let's be honest, mostly wealthy individuals and institutions. And they get paid in a few key ways.
Okay, that makes sense.
So let's start with those management fees. That's probably the easiest one to grasp. It's just like it sounds. Carlyle charges a percentage each year, a steady income stream, just for managing the money, the funds that are entrusted to them.
Okay, so that's kind of like a management fee you'd pay for any other service.
Exactly, you got it. Now, where it gets interesting is carried interest. That's essentially Carlyle's share of the profits. But, and this is the catch, they only get that share if their investments actually perform well.
Makes sense. Incentivizes them to deliver for their clients, right?
Exactly. Big incentive to deliver those big returns. But, and this is crucial, that's where the give-back obligations come into play. If an investment goes south, and believe me, it happens, Carlyle might actually have to give back some of that carried interest they already pocketed.
Oh, wow. So it's not all guaranteed profits in private equity. Speaking of investments going south, I did notice in the 2023 10K that Carlyle had to return, get this, $1.2 billion in carried interest.
Yeah, that was a tough year for a lot of firms, not just Carlyle.
Right, but still, that's a hefty sum. And it seems like it was mainly because of some underperforming funds, particularly in the energy and real estate sectors, from what I gathered.
Yeah, you're right on the money with that. Energy and real estate definitely had a rough go of it.
So how big of a deal are these givebacks for a company like Carlyle? Can they actually hurt them?
Well, let's just say they're not popping champagne when they happen. It's not great for optics, and it can definitely impact their profitability in the short term.
Right.
But here's the thing. Carlyle, like most major private equity firms, they're smart, they diversify, they're not putting all their eggs in one basket.
That makes sense.
Even with that big give back in 2023, they still reported billions in profit overall. So they can handle it to a point. Now, the 10Ks do lay out this almost worst case scenario. Like, what if everything, and I mean every single investment, went belly up on the same day?
Okay, so a truly catastrophic, the world is ending situation.
Pretty much. But the numbers are interesting. In that extreme scenario, their potential give-back obligation would be a jaw-dropping $47 billion. That really illustrates the sheer scale of capital we're talking about here and, well, the potential downside risks.
So a high-stakes game for sure, but it doesn't seem like they're letting that stop them from trying to attract more everyday investors.
Right. It's a fascinating strategy and one we should dig into a little bit more, I think.
It's definitely interesting to see Carlyle going after those everyday investors. It kind of feels like a shift, doesn't it?
Yeah.
Like traditionally, private equity has always been this exclusive club for, the ultra wealthy.
Yeah, you're right. We're talking about funds with minimum investments that would make your eyes water. Millions, sometimes even tens of millions of dollars to get in the door, not exactly chump change.
Right. So what's changed? Why is Carlyle so interested in broadening their appeal?
Well, a couple of things. I mean, look, part of it is just smart business. There's a whole lot of money sitting out there, right?
Yeah.
Regular people, savings, retirement accounts, that kind of thing. Traditionally, private equity hasn't been able to tap into that.
I guess that makes sense.
But it's also a sign of the times. The financial world is changing, becoming, dare I say, a bit more democratic.
More democratic? How so?
Well, people are getting savvier about investing. They're looking for alternatives, ways to diversify beyond just, the stock market or bonds. And frankly, they're seeing these massive returns in private equity and wondering, hey, how do I get a piece of that?
And Carlyle's ready to show them. Right.
Exactly. If you look at their statements in the 10Ks, they're all about democratizing access to this world, growing their pool of potential investors. It's fascinating, really.
Yeah, they're positioning themselves as the friendly face of private equity.
In a way, yeah. But it's not all about new investors. These 10Ks also shine a light on their push into some brand new territory, like, get this, the insurance market.
Insurance. That seems kind of out of left field for a firm like Carlyle, doesn't it?
A little bit, right. But
Yeah.
they're not just dipping their toes in the water. They made a big splash in 2022, acquired this company called Fortitude Re.
Fortitude Re, that doesn't really tell me much. What do they actually do?
So they're what's known as a life and annuity reinsurance company. It's a pretty specialized area, even within insurance.
Okay, so niche market. Got it. But why is Carlyle interested?
Well, the 10Ks shed some light on that. They basically see this sector as a way to use their expertise in a new playing field. They're really good at managing assets, right? And guess what? Insurance companies are sitting on mountains of capital.
Moments of capital, yeah, I can see how that would be appealing.
Exactly. So it's a way to leverage their skills, expand their reach, maybe even create a kind of, I don't know, financial ecosystem where they've got a hand in all sorts of different markets.
That's a really interesting way to put it. Building their own little empire, but with less, conquering and pillaging.
Exactly. Though, let's be real, it's not all smooth sailing. They talk about this in the 10Ks too. They're facing some serious regulatory hurdles, especially in insurance, which, to be fair, is probably a good thing for everyone involved.
Right. Insurance is highly regulated for a reason.
Yeah.
And on top of that, they've got to contend with their competition, right?
Yeah.
And speaking of competition, I did notice something interesting in the 2022 10K. The CEO, he actually called out some of their rivals for using things like AI to analyze potential investments.
Oh, yeah, that definitely caught my eye, too. It's like they're in this technological arms race to find the next big opportunity.
It sounds kind of intense, honestly.
Oh, it definitely is. Carlyle, they know they have to stay ahead of the curve. They're investing heavily in data analytics, building their own teams of tech experts. But, and this is interesting, it's not just about the bottom line. They seem to be putting a lot of stock, pun intended, into their internal culture.
Their culture, how so?
Yeah, like they talk a lot about fostering collaboration and innovation, which honestly you don't always associate with the cutthroat world of finance.
It does seem a bit counterintuitive.
It does. And they highlight their commitment to diversity and inclusion, generous parental leave policies, things like that.
Okay, so maybe they're just trying to be more appealing to a wider range of investors, people who care about more than just the numbers.
That's definitely part of it, I'd say. It's a savvy move, really. They're trying to control their narrative, present themselves as a responsible, forward-thinking company, which, let's be honest, is probably good for everyone in the long run.
Yeah, I mean, it's not a bad thing for companies to be held to a higher standard, especially when it comes to things like social responsibility. So it seems like Carlyle is really trying to have it both ways, maintaining that edge in a super competitive industry, but also adapting to this new world where people expect more from corporations. Where does that leave our listener, though? We've covered a lot of ground here.
We have, and I think it's time we distill it all down to some key takeaways. I think our listeners deserve that, especially after sticking with us through all these 10Ks.
All right, so we've spent this deep dive really getting into the nitty-gritty of the Carlyle Group. We've unpacked their financial strategies, their move towards retail investing, their foray into the insurance market, even their emphasis on company culture. What does it all mean for you, the listener, who brought these 10Ks to our attention?
To me, the biggest takeaway is that Carlyle is a company at a crossroads. They're trying to balance their roots in high-stakes private equity with a desire to appeal to a broader investor base, one that's potentially more discerning and demanding transparency.
That's a really astute observation, and I think it's highlighted by their foray into areas like insurance and their emphasis on things like ESG principles. These are strategic moves that could pay off big time. But they also come with their own set of risks.
Exactly. And speaking of risks, we'd be remiss if we didn't circle back to those give-back obligations. Yes, they're a calculated risk, and Carlyle is diversified enough to withstand some losses. But that $47 billion figure, even as a worst-case scenario, is a stark reminder that private equity isn't a guaranteed win.
Absolutely.
Yeah.
And as an investor, it's crucial to understand that these 10Ks, while incredibly detailed, are just one piece of the puzzle. They're a snapshot of the company's financials and stated strategies, but they don't tell the whole story.
That's such a crucial point. As you continue your own research on Carlyle or any other private equity firm, I encourage you to dig deeper. Look beyond the numbers and ask yourself, do their actions align with my investment goals? Do I understand and accept the level of risk involved? And perhaps most importantly, do their investments align with my values?
Because ultimately, investing is about more than just chasing returns. It's about putting your money to work in a way that you're comfortable with, both financially and ethically.
Couldn't have said it better myself. Well, listener, we've reached the end of our deep dive into the Carlyle Group. We've explored their financial landscape, their worldview, and even their attempts to adapt to a changing world. But the final analysis is yours. Armed with the knowledge gleaned from these 10Ks, you're now equipped to delve deeper, ask the tough questions, and ultimately decide if an investment in a company like Carlyle is the right fit for you.
Thanks for joining us on this journey into the fascinating and sometimes perplexing world of high finance. Until next time, happy investing.